The United States national debt currently sits at $39 trillion. For the first time since World War II, the amount of money the government owes has eclipsed the entire economic output of the country. Carrying a balance this large comes with an immediate mathematical penalty. Right now, the federal government spends $1 trillion a year just to cover the interest payments on what it owes. People hear these numbers and tend to shrug. The U.S. has been carrying debt since the Revolutionary War in 1790. Politicians have been warning about the deficit for decades, and the financial system is still standing. The federal government has replaced sustainable revenue with emergency-level borrowing. This dependency transforms the national balance sheet into a systemic powder keg, turning a fiscal data point into a ticking fuse. Economists generally agree that governments should borrow money for long-term investments. If a nation is building an interstate highway or fighting a world war for its own survival, borrowing heavily pays off over the following decades. Today, the strategy has flipped. The federal government runs massive $2 trillion deficits every single year just to cover baseline daily operations. They borrow to keep the lights on, even when the broader economy is booming. This chart shows the timeline of American borrowing. For nearly 2 centuries, the debt stayed relatively flat. Then, starting in the 1980s, the borrowing accelerated and the national debt began to double or even triple every single decade. 2 massive demographic forces lock this trajectory in place: an aging population and continuously rising healthcare costs. Every year, those obligations demand more cash than the tax system collects. By utilizing extreme borrowing as a permanent feature of the budget, the government has stripped away the financial padding it would normally rely on to survive a genuine economic shock. Beyond the top-line numbers, the national debt functions as a massive pool of tradable assets, U.S. Treasury bonds. This chart illustrates who exactly owns that paper. Roughly 1/3 of the total debt is held by foreign investors, primarily Japan, the UK, and China. The other 2/3 belong to domestic financial institutions, American mutual funds, and the Federal Reserve. This dispersed ownership means the entire system relies on confidence. All it takes is a single trigger event, a sudden geopolitical shock, a war, or an unexpected domestic spending crisis, to make those global investors doubt America's ability to pay them back. If that confidence breaks, mutual funds and foreign nations will hit the panic button, initiating a simultaneous massive sell-off of their U.S. treasuries. Because the debt is supported by a web of jittery, profit-driven funds rather than a central vault, a localized scare can instantly mutate into a systemic run on the U.S. Treasury. We saw a miniature version of this in 2020. As pandemic panic set in, investors rushed for the door. The Federal Reserve had to quietly step in and buy up those bonds to avert a total market crash. A true full-scale bond panic would be too massive for the Federal Reserve to absorb. The U.S. government would be left completely exposed to market forces. To stop investors from fleeing, the Treasury has only one emergency defense mechanism. They must drastically raise interest rates, doubling yields from 4% to 8% to keep buyers interested. These Treasury yields act as a gravitational pull. When the government's borrowing rates spike, consumer mortgage and auto loan rates are dragged directly up with them. The immediate real-world effect is severe. The monthly cost of buying a house or a car doubles overnight. Credit dries up, consumer spending freezes, and the broader economy chokes. A bond panic functions as a direct conduit, instantly translating Washington's financial dysfunction into crushing household poverty. Facing exorbitant new borrowing costs and a shrinking tax base, the government faces brutal math. To afford the new rates without completely defaulting, they have to instantly find trillions of dollars. They are forced into overnight austerity. That means indiscriminately slashing the foundational services the country relies on, draining funding from Medicare, Social Security, infrastructure projects, and national defense. The policies required to prevent this spiral are well known. Enact structural reforms to entitlement programs, and raise taxes to cover spending. But politicians refuse to take those steps, because asking voters to accept fiscal pain during peacetime is considered political suicide. This paralysis is entirely bipartisan. Successive administrations have consistently chosen to artificially stimulate the economy with borrowed money, rather than enforce basic financial discipline. By prioritizing their political survival today, elected officials guarantee extreme economic austerity tomorrow. They are effectively acting as the architects of a coming domestic crisis. Currently, the United States relies on one final safety net. Because the US dollar is the global reserve currency, international investors still need a safe place to park their cash, keeping the bond market functional. But that geopolitical buffer is not invincible. If the global market finally loses faith in America's financial sanity, the US will permanently lose its ability to borrow its way out of trouble. Back in 1936, President Herbert Hoover noted that future generations would inherit the national debt. Historically, Americans accepted periods of shared civic sacrifice to pay down those burdens. Today, there is an absolute refusal to accept any short-term fiscal pain for long-term stability. This massive $39 trillion debt operates as a mechanical, active threat, steadily ticking toward a dangerous zero hour. The ultimate price for Washington's permanent borrowing won't be paid by the politicians who approved it. It will be extracted directly from the wealth, opportunity, and stability of